Right, Eddie, I have to ask first of all, right? You're the banking person, not me. What exactly is MFRS 9, besides being a mouthful?
It is a mouthful, but besides being a mouthful, it is an international accounting standard. It's a new one that's coming into place in 2018 that has the biggest impact for banks. It also affects other companies, but banks, I think, are going to be the more significantly impacted. And it basically changes their approach towards loan loss provisions, where once upon a time, banks would only make provisions when something already went wrong.
Okay, so basically, yeah, so that means if I took a loan and let's say I didn't pay it back, only then they would make the impairments, right?
Yes. Something like that. And then, but from now on, banks have to make provisions for expected losses in the future. So from the day they extend any loan, they're going to have to make provisions.
So let's say you take a loan, I take a loan, you have a better credit history than I do, I have, let's say, a worse one, touch wood or whatever. Does that mean that they will probably make less provisions for you and more provisions for me?
It really depends. There is a model that all banks are building right now, and the model is divided into stage 1, stage 2, stage 3.
Yeah, which is here.
We have actually put out the basic model out here, and depending on what the assumptions they make and what kind of judgment calls they make, it really depends.
All right, but for Joe, normal, you and me, does this mean that it's just going to be harder for us to take loans, any kinds of loans, house loans, car loans, personal loans in general?
It remains to be seen because banks have already been moving towards risk-based pricing for a while now.
All right.
From what we gather, experts are saying that loans might get more expensive for the borrower. We asked the banks, we spoke to 6 of the banks responded to the questions that we sent out, 2 state silent. And of the 6, none of them really said that loans were going, none of them acknowledged that it would go up, but the experts seem to think that it will. Yeah, it will make loans more expensive, especially if your credit profile is on the riskier side. Because banks are going to take a lot of risk on you. So
so it's going to be harder for them now. I mean, under this new standard, they have to take even more of a cautious stance on you, right? Because it's
you would think that banks might be a little, in the beginning at least, they might be a little bit risk
wary kind of thing.
Yeah.
Well, if I'm a stakeholder in a bank, shareholder, stakeholder and all that, do I have to be worried about earnings, especially considering how well banks did this year?
Yeah, banks, if you notice, banking stocks really ran up this year, right? But, we spoke to analysts and a lot of them have neutral calls and a neutral investment stance on the banking sector. So, and one of the reasons for that is because, they are a little bit, cautious about how MFRS 9 might affect the banking sector next year. Because, don't forget, provisions are supposed to go up. And if provisions go up, then it's going to have an impact on their profitability. And it affects profitability, then it might affect dividend payout. So, and then there's also concerns about capital, although that's not a huge concern because Malaysian banks are actually quite well capitalized.
In the grand scheme of things though, considering how bad 2008 got with all the subprime crisis and everything, MFRS 9, is it a cautious necessary step?
That's just the thing. MFRS 9, the international standard is called IFRS 9. The Malaysian equivalent is called MFRS 9. So that was actually designed to address the too little, too late problem that came about following the 2008-2009 global financial crisis, right? Because then banks were only able to make losses after they were incurred.
Which is kind of like closing the stable door.
It was going to come.
Closing the stable door after the horse has already bolted, right?
So this was meant to address that. Let's put out the provisions up front. You call it front-loading provisions. So if we were to go into, let's say, an economic downturn, there's not going to be any sudden shocks on banks. So in that sense, it's a good thing.
For more on the stories, pick up a copy of The Edge Weekly at all good newsstands.